I'm going to talk about a really awesome strategy, one that probably my favorite. It's really great for different kind of conditions in the market, but I like to use it a lot for directional trading. So it's the high reward, low risk option trading strategy, and it's the butterfly. So we're going to go through a six-step plan here today. The first step is the strategy itself. How the strategy works primarily, and then the most important option factor, what factors of the option, Greeks and stuff, affect the butterfly, how the option pricing works that influences the butterfly, selecting the right option butterfly strategy, and then we're going to look at some trades and hedging using the butterfly strategy, and then how do you, bring everything together so that you can incorporate it into your trading. So the following webinar today is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice, excuse me, and should not be construed as a recommendation. So thanks for the introduction, Dan. I've been actively trading for over 30 years and was previously executive vice president for one of the largest oil trading companies in the world, Trans World Oil, and ran their international trading desk for over 10 years out of the beautiful island of Bermuda. So if you ever get a chance to visit Bermuda, make sure you take advantage of it because it's a beautiful, beautiful place. And it's not too far from the U.S. It's only about 700 miles off the east coast of North Carolina, and so it's right out there in the Atlantic Ocean, and just a beautiful spot there. Great people, great water, and a great experience for me as far as trading. I lived there for over 15 years and ran the trading desk for 10 for this company. But our primary thing was oil, but then we diversified out into all the other various derivative markets and eventually into Forex for the liquidity. We started trading options over the counter back in the 80s, and that's where I first got my exposure to options and have been passionate for the option markets ever since. Went on to launch an institutional over-the-counter crude oil options brokerage desk for a company called PVM Oil London. They're the largest privately owned oil brokerage company in the world, and just another really great experience. And that was the kind of first place that I really got into butterflies, because some of the big institutions would put on some massive butterfly trades because of the structure, which you'll see as we go forward here today. So here was a picture back circa 88, I guess, in Bermuda. And you can see the kind of how dated things were with the old computers. But this is where we did all of our trading. It wasn't with trading. It's such a great profession because it doesn't really take. In our group, we had a very small group, but we controlled and traded a lot of different commodities and barrels. But the thing that's so great about trading is that it's so rewarding because you can do it from any place pretty much in the world. We've got people here, I heard, from Singapore and South Africa and all over the place. And if you have an internet connection and a computer and your charts, you're ready to go. So it can be super rewarding, but you really need to also stay very educated about what you're trading and stay focused on managing your trading risk. It really comes down to risk. But it can also be a painful and stressful profession at times, which probably everybody here can attest to. So today I'm going to share with you one of my favorite strategies, and I call it the high reward, low risk, low stress option strategy. It's the butterfly spread. So, the strategy itself can be structured for very high returns, and low capital at risk. And so, when I was trading and running the trading group, we traded, big, huge amounts of dollars. But now trading for my own account, a totally different strategy. I like to take, very short duration trades to reduce risk, and I like to really have defined risk as far as my capital exposure. So I found that the butterfly spread is perfect for this, and so I call it the high reward, low risk, and strategy that also can really help you to reduce your market stress, which is, I think, important as a trader. So when you're getting tired of the market's uncertainty like we've had and we continue to have in periods of high volatility that can really start weighing you down, there is that one option strategy that I've found that can really give you a trading advantage and in any type of market environment. And it's, again, what I call that low stress option butterfly. So option trading in general, has many more advantages than trading stocks, but as you probably know, it can be a bit more complicated as well. And for the individual trader, options can be a little intimidating as well at times. But the option butterfly I found is one strategy that is really something that you should really add to your toolbox, your trading toolbox, because it can really add additional types of income and smooth out your returns. So why trade the butterfly? Well, unlike other option strategies such as iron condors or credit spreads or debit spreads, the butterflies are very dynamic and they can be traded for a variety of different reasons with different trading goals in mind. So it can be used for income. It's a great way to generate income from stocks you think are going to go nowhere in the short term, and this can really help you to contribute to your overall portfolio returns in a flat market. So they're also, what we call non-directional. In their simplest form, the butterflies are a delta neutral or non-directional type of strategy. And, trying to pick directions of stocks or the overall market can be stressful and expensive at times, when you're not really certain about market direction. Now, these delta type neutral butterflies then can be set up to take advantage or take the guesswork out of your trading, and they can be structured to give you a very high return on very low capital at risk. So that's the thing that's so great about them. They can be almost like a lotto trade or a lottery trade, and you can structure these things for 10-to-1 or higher reward to risk on these types of setups. So when you add a few of these into your portfolio and you get one or two to hit, it can really add some great profits to your portfolio, and on a very, very limited amount of capital that you put up to risk. Now, they are also very great for directional, and this is where I really like to use them. And the directional butterfly offers you a bullish or bearish exposure to the market while still, really helping you to manage your risk and to retain large potential returns. So even though butterfly spreads cannot offer unlimited profit potential, they usually will cost you a lot less than if you're buying just outright options, and offer an amazing positive risk rewards trade setup to you. So the other thing that I love about the butterfly, and I found it to be probably the best go-to hedging strategy. So this directional butterfly can be used as a fast to execute hedge on any of your positions that might start moving against you. So by constructing a butterfly, which I'll show you a little bit later, around a strike that is under pressure from your core position, such as, let's say you had a credit spread on or a debit spread, you can construct a butterfly around it, and it becomes a great way to control your risk, and that's going to really, lower your trading stress. So you can neutralize your risk really quick, and you can also then reduce it by constructing a butterfly. It also allows you then to keep your original position. So if you've got a trade that you've set up, a debit spread or a credit spread, and it starts to go against you, you can immediately set up a butterfly around it to neutralize that risk and wait it out. So you've probably seen a lot of times with your trades that you get into a trade, you might get in a little bit early, might get in a little bit late, it goes against you, then you ended up stopping out, and then it goes the direction you originally thought it would go. So what I've found is by using the butterfly as a hedge, it allows you to reduce your risk, lower that potential loss that you might have, and then hold on to the trade a little bit longer until maybe it turns around. And that's a really great advantage of it. So you can get into the butterfly, it neutralizes it, you wait, and the other thing great you'll see about the butterfly is it's a positive theta, so it takes advantage of theta decay, which helps you as that market might go sideways. Then once it corrects, you take the butterfly off, and your core position can go on to the direction you originally set it up for. So it's fantastic for hedging, which I'll show you a little bit later. It's also called a low maintenance kind of butterfly or strategy, and sometimes they're referred to as the vacation trade due to their low risk and need for only very infrequent type of monitoring. So the butterfly trade generally will start out very slow moving, so you can put it on and kind of go away, kind of like a vacation, and then as you get closer to expiration, that's when you want to come back, start monitoring that trade, and look for it to hopefully go in your direction. and this is what we call the profit tent. So you can see the butterfly here, the basic component or structure of it looks like kind of a butterfly. Let me get my drawing tool. So you get, here, and then here's your tent. So what you want is, it can be outside this profit zone area, and then at expiration, that's when you're targeting this particular expiration point. And if you get a pin right here at the body of the butterfly, that's where you get your optimum profit. So there are a lot of different ways you can construct these, which I'll show you as we go forward. So step 2 then is the most important option factor for profit generation using the butterfly strategy, and it really comes down to understanding the concept of time and the effect that it has on a price of an option. So time value is really the key component for option trading, in my opinion, and it's used for trading strategies that take advantage of the accelerated time decay of an option to its expiration. So it's great for taking advantage of that. Now the butterfly strategy is very, very tied to time value and the theta. Now theta is the Greek that we can use to measure that time decay and the impact that it has on the price of the option. So this, strategy really takes advantage of this time decay or time value and the theta decay of an option. So the time value is also known as the extrinsic value of an option, and it's the premium that a rational investor would pay over its current exercise value, the intrinsic value, based on its potential to increase in value before expiring. Now, this probability is always greater than 0, thus options are going to be always worth more than their current exercise value. And the change in the value of an option based on time decay, we can measure that using the Greek theta. So that's a pretty cool thing about options, that you have these various Greeks that you can use for measuring certain aspects of the price movement of an option. So you can measure, theta decay, time decay. You can measure what the impact of volatility will have and the impact of price change will have. So you've got all these little tools that you can use for the options to tell you and kind of help you forecast where a price could be on the option moving forward in time. So the option theta is one of the key ones, though, and it's going to tell you how much that option price will diminish over time, which is the rate of time decay of your stock's option. And time decay occurs because that extrinsic value or time value of the option is going to go down or diminish as expiration draws near. So it's a decaying asset which will go to 0 at expiration. So by expiration, options will have no extrinsic value, and all out-of-the-money options are going to expire worthless. So the rate of this daily decay all the way up to its expiration can be estimated by that option theta value. So by understanding theta, it becomes extremely important for the application of option strategies that seek to profit from this time decay, such as a option butterfly or credit spreads, etc. So what are the characteristics? Well, the theta values are going to be either positive or negative. So all long stock options, such as a long call or long put, will have what we call negative theta value, which indicates that they will lose value as expiration draws near. And all stock options that are short, such as a short call or short put, will have a positive theta value, which indicates that the position is going to gain value as that expiration draws near. So theta, you'll see, is going to be highest always at the money of your options, and it's going to get progressively lower as you go in the money or as you go out of the money. And the in the money and out of the money options are going to have much lower extrinsic value, and that's what's giving you little left to decay. So that's why they go down. Now here's an example. So if you had an option contract with an option theta of minus 0.10, that says that you'll lose $10 per contract every day, even on the weekends or market holidays. So remember, one option contract is equivalent to 100 shares, so 0.10 would be $10. Now if you were to buy an option contract over a 3-day long weekend and you pay $40 for one option contract, and it had an option theta of minus 0.10, you're going to find out that the price of that option would be $110 instead of $140 after that 3-day weekend. So that's that theta decay, striking you and hurting you if you've been an option buyer and you're not aware of it. So option theta does not remain stagnant either. So it's going to increase as expiration draws near, and it's going to decrease as the options go more in the money or out of the money. So in fact, the effects of option theta decay is most pronounced during the final 30 days of the expiration. That's when it really soars. You really get that accelerated time decay. So here's an example. If you look at a time graph here of what the decay looks like. So if you start out in time, say 120 days out to 90 days out, the further you go out, the smaller that theta decay will be. You'll barely notice it. Now, as you get closer to expiration, when you get to about 30 days out, that's when it really starts accelerating. And when you get into these weekly options, which most options have now, then it really starts to accelerate. I call it kind of turbo time decay. So it's kind of like swimming against a real swift current. If it's going out and you're trying to swim against it, you're getting nowhere. And that's the same kind of concept. If you're buying options as expiration gets close, you're having a difficult time making money on those unless it really has a powerful move in your direction. So before you know it, it's at zero, and those options will be worthless based on that time decay. So it's important to understand that. Now here's some examples. This is to illustrate how much larger time decay is as you're close to expiration. So this is an example with Amazon. This is an option platform or option chain, and this is on Amazon. So you'll see here on this example, Amazon's at the money, it's trading at 765 basically. Now if you come over here, you'll see that it's got 7 days to expiration right there. And if we come down to the at the money strike, 765, and come over to theta value right here on the calls or theta value right here on the puts, you're going to see it's going to be the largest. So if you look here, you can see it's minus 0.39. So let's call that close to 40 cents, right? So that's 40 cents. That would be 39 cents or $39 per option contract. So if you'd bought this 680, this call right here at the money, the 765, and you'd bought that, and you come back the next day, and the price of this Amazon has not changed. The price of this option is going to drop by 39 cents or $39. So instead of being $680, it's going to be $641. So you can see just one day that can be a very big hit to your trade. And the same goes for a put if you bought the put. Now as you go in the money, here's 750, that's going deeper in the money. You can see that theta is smaller. It's only 0.25 on the calls and only 0.27 on the puts. And as you get further out, 785, it's smaller too. It's 0.19, 0.21. So you have less extrinsic value as you go in the money or out of the money. So the biggest impact is right there at your money, at the money. So that's the thing that you really need to be aware of. Now, the next slide I'll show you is even further out in time, so you're going to see that there's less theta decay as you go further out in time as well. So here's Amazon 42 days out, and you can see that it's also in this trading still 765.98, 42 days to expiration. You come down to the 765 strike, you can see that theta decay is only minus 0.22. So you're only losing 22 cents or $22 a day versus as you're closer in, losing close to 40. And then as you go in the money, it also becomes less of a hit on your the value of your option. So there's the old saying that if you're a buyer of options, the time is the gift, is your gift. You want the gift of time. So the further you're out in time buying options, the less impact that theta decay or time decay has on your options. So it really accelerates again as you get closer to option expiration. And that's how I'd love to take advantage of the butterfly, because they can be used for these very short duration trades, and they can be used with very low capital at risk. So the next component is then, or step, is how does the option pricing work? So if you see the option pricing, how it flows, then you kind of understand the variables and the impacts that it has on that price. So the main components of an option price is time value times its implied volatility times the underlying value, which is the intrinsic extrinsic value. So once you know these variables, then you're going to be ready to price out your option and know what its option premium should be. So here's another example, kind of go through this pricing mechanism. So most of the big options now will have weekly options. So this is a weekly option chain, and every Thursday you have a new weekly option that comes out. So on Thursday you'll have 100% time. So if you take the time value times the implied volatility of the option, which will be given on your model, times that underlying value, the intrinsic, we'll keep that at $1, and then that gives you the price of your option, or the option premium. So on the first day, you're going to have 100% time, and if you have the implied volatility, you have it at 300 times the intrinsic underlying extrinsic value, which is your underlying value. That would give you a $300 value of your premium. Now you can see here on a Monday, if you come in, that time decay goes down, is cut in half. So even if you have a big spike in implied volatility, say in this example to 800, you can see that your option premium, does not go up hardly at all. Now let's say you had the implied volatility here of 300, and you had your time decay cut in half. Then you can see your premium's gone down, and now it's only $150. So these are two key components for pricing your option: time value and the implied volatility, and they're going to go to zero at expiration. So if you're not aware of this and you're constantly always buying options, you're going to always, usually be on the wrong end of the trade and tend to lose more than you make. So this is very, very important to your trade setups and strategies that you use. So the step 4 then is selecting the right butterfly option strategy. And in my opinion, one major goal of, as being a trader should be to select trades that are based on what's going to provide you the most consistent positive return with low defined risk, and not always that greatest return. So I like to structure my trades with very low risk, and I like, again, low risk to me means low capital that I put up to the trade and short-term duration, because if you think about it, the longer you're in a trade, that equals more risk, more things can happen. So this type of strategy becomes a really great one for these shorter duration type of trade setups, and for also really getting your capital costs low. And one of the best ways to achieve this is then knowing the option butterfly strategies that are available, how they work, and then selecting the one that's going to be best suited for the market environment you're trading. So there are a bunch of different types that can be used for all different types of market environments. So here's a kind of an overview of the different strategies. So you've got the long call or put butterfly. You've got the short call or put butterfly. You've got what we call a broken wing butterfly, which you can do with calls or puts, or sometimes it's referred to as skip strike butterfly. You've got the unbalanced butterfly, which is also referred to as the ratio butterfly. And then you've got your standard balanced directional butterfly. You've got the iron butterfly that takes advantage of what we call volatility collapse. And then you've got hedging. You can use the butterfly, like I mentioned earlier, for different type of hedging against either types of vertical spreads, the credit spread or the debit spread. So you've got a lot of different flexibilities of using the butterfly. It's not just one particular strategy. You can use multiple different types of strategies using that butterfly concept. Now let's go through here and show you some of the trades and hedging aspects and benefits of the butterfly. So here's the first one is just a directional option butterfly, what we call the balanced butterfly. And they're great for doing ETFs, such as SPY or the Russell IWM or QQQ. So they're great for pretty much anything, but with the ETFs sometimes they're perfect because the spreads are so tight and liquid. And I like to use these for what we call kind of a pinning type strategy, where you have a direction in mind that a particular ETF will go to, and then you want to set up a strategy at that particular strike if it was to kind of expire there, and you can make some really big returns by doing this. So here's an example. This was S&P SPY, and this is doing a put butterfly. And so, every time I put on a trade, the first thing I do is I want to know directionally what is my target. So I don't put on a trade without knowing what my exit target will be and what my so that would be my profit target. And I also want to know then what is my at risk going to be, what's my stop going to be, or am I going to defend the trade? Where am I going to defend the trade? So I've got a plan in place ahead of time before I put any trade on. And this is what I teach to all of our members, that we always first, okay, what's the target that we're looking for, and then what's our management plan. So it's pretty standard stuff that we do. And in this particular trade, it was a very short duration trade, and it was trading at 202 SPY, and we were looking just for a move to 205, just a very short $3 move. And that's the thing, that these butterflies can trade very short little price movements but make really good returns. So this was put on like on the 15th and just taken off 3 days later. And that's short duration, so you've got very little time in a trade for the market to really mess you around. So what I like to do is use Fibonacci to set up my targets and then the expected move of the option. So in this particular trade setup, you can see it's a very tight trade. So look from that high to low, it gave me a target right here of the 1618 extension of a Fibonacci right around close to 205. Now the other thing I like to look at is the open interest. There was a huge amount of open interest at the 205 strike on both the calls and the puts, and so that gave me a really solid target to trade against. Now I didn't want to put up too much capital on this trade, but if it worked and it went out at 205, I had a potential to make some really good return on my capital at risk. So here's the trade setup. So this was going long a 206 put and then short the 205 put. So if you look at that just on its own, that would be a vertical put debit spread, so the 206, 205. Then the other part of this butterfly, to construct the butterfly, is then selling the 205 put, buying the 204. So that's a bull put credit spread. So you put the two together, it's the butterfly. You can see it's $1 wide, 206, 205, 205, 204. The body is where you're short more than you're long here. So that's the body of the butterfly. Now the structure here is perfect if you're looking for a good target, and we were looking for a target of 205. So you can see that this particular trade, very tight, and by constructing this trade, it was only $14 at risk. So if you take, it was a $100 widespread minus the cost, $14 debit right down here, $14 debit. So that puts your maximum at risk as the debit paid. So the maximum you could lose if everything went wrong is $14. So your maximum, though, theoretical profit is the difference. It would be the 100 minus 14. So that's 86. You've got a potential theoretically to make 86, which would be over 600% return, or 6 to 1. Now, I never look to make that full theoretical profit, but think about it. If you can make 30% of that, 40% of that, 50% of that, still a huge return on your capital at risk. So when you go in a butterfly, don't be expecting to make the full return, but look to make, if you make 30, 40, 50%, you're doing great. And on this particular setup, it made $37 per contract. So 37, your capital at risk 14, that's still a huge return on your capital at risk. So that's the beauty of it. You can do these with small accounts. So here was a trade setup, 206, 205, 204 put spread, $14 debit, max at risk, and we're looking for a move to 205 or close to it. That would be inside that profit tent. So here's what it actually looked like as it was going out on the 18th, which was the expiration. So you can see here's your, what we call that profit tent, and the expiration here, what we wanted was for it to be as close to 205 as possible. That would give you your max profit. Now it went out right around 204.55 right here, and that ended up being a $37 profit, okay, when it was taken off. And that's a really great return on your capital at risk of 14. So if you do 5 contracts, 10 contracts, you can see how that can really add up and add to your portfolio. So this is a really great trade setup for certain conditions, and it's one that you can put on and you don't have to stress about it. Your risk is going to be your premium paid, and you can get these a lot of times on for 15 cents, 10 cents, etc. So you add a few of these to your portfolio. If you get a couple that hit, it can really make a difference. And then if you're wrong, I call it kind of a cup of coffee at Starbucks or 2 cups of coffee. So that's kind of the way you can look at it, add to your portfolio. And again, you can do these for directional trades. If you think there's a certain target that's going to hit, it's going to probably stay there, and you can widen the spread out. So a lot of different ways to control that trade. Now, this is my favorite, and this is one I go to a lot, and this is one of the probably my favorite option strategy. I like credit spreads, I like this spread, I like debit spreads, but I really, in certain situations, love this ratio butterfly. So you can construct this for a bias to the upside or downside. So you can make this into a directional trade with very low risk. And the beauty of it is you can do it and collect a credit going into it. And so here's a really really cool example here to show you the great benefit of this type of strategy. So this was on NVIDIA, and this was a directional trade setup, just looking for a small move. This is what's pretty incredible about it. So it was trading at $64, and we were looking for just a dollar move up, just $1. Now, this is what we call a volatility squeeze. So I was looking for a break, just a little pop up here. The reason I was looking for 65 is this was a big Fibonacci level. So it did not think it could get through 65 by expiration. So it was on the 21st, expiration was the 23rd. So it only had 2 days to expiration. So this was a really short duration trade, just looking for a little pop into the fib level right here, which you'll see next. So you can see these are my momentum indicators down here. So everything was up. So the high probability that it would pop, but that it would not probably get through that line of Fibonacci level until maybe the next week. So this was just taking advantage of a dollar move. Now, if it looked like potentially it could really break out to the upside, so set this up using the ratio put butterfly that would profit if it kept going up and give you the max profit if it just stayed there at 65. And that's the really beauty of it. So here's what it looked like on the fib levels. You can see the high to low here, right here. Take my high to low, gives me my first target there, which it was already at, and then here's the second target that we were looking at, the 1272 extension, right here. So here was the day it was put on, took profit that day, and then kept some for the following day, which was expiration. I'll show you how that worked out and why it was set up that way. Always have a plan in mind. So here was the initial trade setup. This is what I call that directional put ratio butterfly. So entered into the 21st and then took off some the next day and then at expiration. So received a credit of $29. So got into this trade with a credit actually. Did not have a debit, so it's kind of like a credit spread. So received $29 credit. Now that risk would be the difference in the dollar-wide spread of 71, but it had really strong momentum, so I was okay with that risk. Now the maximum potential profit on this trade would be if it was to pin and go out on the 23rd at 65, the theoretical profit would be $129 per contract. That'd be 181% return on your capital at risk of 71. So the advantage again is you've got that positive theta, so time decay works in your favor, and it's a low capital at risk. You know what your risk is. Now, this is the thing that's interesting on this setup. So the 22nd took part of the profit for $44 per contract. Okay, so it popped up real strong on the 22nd, and it went to exactly it went a little over 65. So it took off part of the trade at $44 profit. Okay, so if you look at $44 profit, your risk of 71, that's a 62% return in one day. Now, if you just bought NVIDIA, the shares, and you took it off the next day, you would have made that's a 1.50% return on your equity. This was a 62% return in one day. Now the cool thing here is then the next day was going to look to see if we could get a pin, where when I say pin, that means go out at expiration and go out at 65, and it almost went out to the penny, and it made 119. So that's 167% return in 2 days. So The really interesting thing about this strategy is that you can, at the same price, here on the 22nd it made 44 and it was trading at 65. On the next day it was trading just a little bit under 65 and it made 119. So here's how that works. So here's the credit, received $29. You can see here's the butterfly down here. So it's buying the 66, selling the 65. That's your vertical put spread. And then you're selling 265, buying 264. So it's a 2-to-1 bull put credit spread versus the debit spread. So you combine that together. That's what we call that unbalanced or ratio butterfly. Max profit here, 129 theoretically. Max loss would be 71. Now, the next day, it popped up, and so took off when it was at 65. Took off part of the trade, and that was $44 profit, okay, per contract. So it went from a 29-cent credit down here to 15-cent debit. So it totally flipped. So 5 contracts, $44. That's over $240. Now your risk was 71, so that's a 62% return. So here's the neat thing. So 65 that day, on the 22nd, 44. Now the next day it went out at expiration at 64.95, so it's actually 5 cents below where it was on the day before, but it made $119. So, you know, tripled the amount of profit, and that's 167% return. So you can see that it went from a 29-cent credit to a 90-cent debit the next day. So, you know, the other 5 contracts, or 3 contracts there, made $119. So that's the structure. So you can see that kind of that purple line is almost identical to the teal, which is the underline. And that's where you can use this type of strategy if you can get a really good target. And if you're wrong on this particular trade, if it really blew to the upside and kept going, you still make $29 credit. So that's the thing I love about it. So it's a very good directional trade setup if you have a target in mind, and you can set it up as a credit. If it blows through your upside target, you still make money. So, well, you know, you factor in your commissions, the return's still great. If you're making $119 per contract, you can go figure what is your commission cost on that. So the returns are real good. And on that trade, if you just bought calls, you would have not made as much money. So you have to weigh in your commissions, but you know, I don't look at the commissions as much as I do the strategy, and if the strategy is good, then you know, I want to do it. So here's another example. So this is on Facebook, and this is again a directional trade. We were looking for a big move to the upside. So this is what we call a volatility squeeze here. You can see right here. So this is a volatility squeeze. And again, I like to use Fibonacci, but my momentum was hard to the upside. So we were looking for a move, a breakout of this range, and we were looking for a target of 133. And again, that was based on a Fibonacci level up here, this 1618. So on the 20th, it was trading at 130. We were looking for a target of 133 and thinking that it could really maybe even blow through 133. So set up this put ratio butterfly to take advantage of any upside move. Now, here's what it looks like when you look at the setup. So on the 20th, out the 24th, so very short duration. This one was set up for a $50 credit. That would put you at risk of 50. So it's a dollar-wide spread. 50 cents would be the maximum at risk. If it kept going to the upside and broke above your 133 strike down here, you make $50 credit. And your max potential theoretical profit would be 150. So you've got different options as far as your profit. You can potentially make theoretically 150. Worst case scenario, make 50, and further only lose 50. So this actually popped to the upside and took it off for $30 per option contract, and that's a 60% return in 4 days versus if you just bought the shares and took it off, would be 2.3% return. So much lower at risk. If you think about if you're buying shares, you've got much higher risk. If you're buying just outright calls, you've got much higher risk. But with this spread type strategy, you've got much lower risk. You've got more ways to make money versus just having to be right on direction. So if you think about it, if you're long if you're trading directionally, you can only make money, let's say, if it goes up on a long or down on a short. With this butterfly, you can make money if it goes up, or you can make money if it just goes to your target. You can make even more money. So you've got two better options for profit take than if you just did a directional trade outright. So here's what it looks like when you put on the Analyzer tab. You can see this kind of profit tint here. And your risk then is, this is your risk profile. Your risk is here, $50. And your potential profit, max profit, would be right here if it was to pin at that 132 strike. And if it blew to the upside over 133, you keep the credit of 50. So this was taken off just on a really quick pop to the upside. Took it off for $30 per contract, which is a nice return on your capital at risk. So, you know, those are kind of great setups, and these can be very, very fast. So that's the ratio butterfly. Now, the next thing I wanted to show you is for hedging. So for me, if you don't get anything else out of this presentation here today, the biggest benefit of the butterfly is to add it to your toolbox for hedging positions, your option positions. And so in this example, you'll see this was originally a short bear call credit spread that was set up, and it started going against, going against the trade. It started to be threatened as far as not being a profitable trade. So before what I call the post line in the sand got hit, I set it up to defend it using the butterfly. So here's how that works. So again, whenever you go into trade, always have a plan as to what you're going to do. What's your target for that trade as for your profit target? What's your stop loss going to be? And if you're going to defend it, where are you going to decide to defend it? So this trade was set up here when SPX was trading at 2055. This is the S&P 500 cash. So it was going sideways basically. So sideways price action, looking for that continuation of a sideways move or potentially down. Now set this credit spread up about 1 standard deviation out of the money. Okay, so it's set up it's structured for sideways price action to take advantage of theta decay, or if it goes down, it would really take advantage of a down move. But if it goes up, then it could turn into a loss. So when you put the trade on this particular one, it's trading at 2055, I had what I call my post line in the sand. If it was to trade above 2070, it was going to stop out or defend it. So the defensive line was 2070.71. Okay, so that was the plan, and then here's the action. So if you look here, it was trading down here at 2055 right here. So set this bear call credit spread up above, out of the money. This was about 1 standard deviation out of the money. So sold the 2085, 2090 bear call credit spread up here out of the money. So when you do 1 standard deviation, that gives you theoretically about a 68.2% probability of a winning trade. So that's the other great thing about out of the money credit spreads. So I was looking for this to either go sideways or go down. Now I had that line in the sand though. If it was to start breaking above these highs right here, which was 2070, then I was going to either stop out or hedge it. Now by hedging it, here, then there's still the potential it might come back down, then I could take the hedge off. But if it went up, I've reduced my at risk, and I could still look at getting out, at a later date. So it gives you flexibility to do a couple different things. So here's trade 1, trade at 2055. So it was selling the 2085-90 bear call credit spread, 1 standard deviation out of the money, approximately. Gives you a 68.2% chance of winning. Credit received $105, $1.05. So your at risk is the difference. It was a $5 wide spread. So your at risk is $3.95. So looking to make, $105 or 80. What I'll do is if I can make 80% of that or 70% of that, I'll take it off. But if you kept the full credit, that's a 26% return. That's a good return. So there's what it looked like, $1.05 credit. Now had that line in the sand at 2070, and so here it started going above 2070. So I immediately hedged it instead of waiting around. You've got to take action on your plan. You don't want to sit there, well, should I do this, should I do that? Just take action. So when it started to hit 2070 on this day, the 13th, I set up and constructed it, turned this to a butterfly. So here's how that worked out. So trade 2 was to go long a call debit spread. So by doing that, I went long the 2080, short the 2085, vertical call debit spread. That cost $230 per option contract. So your max risk is your premium paid, $230. Potential profit if you did that just as a debit call vertical spread would be $270. So here's the debit spread side. Long the 2085, short the long the 2080, short the 2085 for $230 debit. Now what you're going to see here is when you add the two together, that creates your butterfly. So spread 1, the original trade was short the bear call credit spread 2085, 2090, $105. Trade 2 was defending it, hedging it, bought the 2080, sold the 2085, $230. Now you'll notice the short strikes are the same, 2085 on the bear call credit spread, 2085 on the debit spread. So there's your body. That costs $230. Now when you put these two together, $230 debit minus $105, now your risk is just reduced to $125. So the original risk was $395 on the credit spread. By doing the butterfly, I neutralized that risk down to $125. So if it cratered to the downside, blew to the upside, the max I could lose is $125 versus $395. So for me, that reduces my stress. I'm not stressed out about losing $395. Now I know that I've really cut my risk down a lot, and I still have a chance to make money. So I can make good money if it goes out there and settles at 2085, or I can leg out, or I can add to it. So it just gives you a lot more flexibility and options as a trader. So let me get rid of this pen. Whoops. So here it was, line in the sand, but you have to defend it before it gets to your short strike, otherwise it's too late. Now this thing just blew to the upside and went to 2097. Now when it blew up here, it was very close to expiration. So what I'll do is I'll if you want, you can leg out. So I used like a 5-minute chart. When it spiked up, I sold off the call spread side, took profit, pulled back a little bit, took off the credit spread side, lost money on that, but net it actually made. So here's the outcome. So the first trade closed out what I do is, when it's taking advantage of the momentum, it was pushing up real hard. So went out and closed out the long call debit spread. So long the 2080, 85 at 230, the debit. And so it spiked up. It was max profit. So $500 got out. The difference, 270, is the profit. Okay. Now, so that side made profit. The short bear call credit spread, though, was losing. Now, if I'd done nothing, that would have lost $395. But went ahead and then closed that out. And when I closed that out, that lost money. So I had this original trade on for $105 credit, closed it out at $350. So that lost $245. But made $270 here, minus the $245 lost, ended up making $25 per option contract, or 6.3% return, versus losing $395. So when you're trading, you don't want to ever lose your max on anything you're doing. It just sets you behind so much, and especially when you're doing credit spreads. So it's kind of like a campaign. So instead of losing $395, worst case scenario, if I'd done nothing, I would have lost $125 on this one by legging out, made $25. So it's just a great combination of different things that you can do to help your portfolio. And so we're always looking for different edges and strategies. And for me, I don't want a whole lot of risk and I don't want a lot of stress. So this is one strategy that I really like, and I've been using it over and over and over. Just keep going back to it. If there's a situation I can use it, I'll usually go to it. So I hope this was educational for you, and the other part of it, that hedging aspect, is just the best. So if you want to learn more about this really what I call amazing option strategy, I've got a great program for you and help you to bring it all together. So I've got a course that I did, and now it's on demand, and it's only $97 for everybody here today. Actually, the first 20, but I'll let in a few more if you sign up early. So here's all the bonuses. So here's the link here. It's PowerCycleTrading.com, and then / just the word go, G-O, everything small cap. So it's a really great package. This was an on-demand course I did 2 months ago on the butterfly. So it turned out it's close to a 5-hour course, and it's 100% on the butterfly, all the different strategies. I couldn't go through everything here today, but in this course I do. So you'll get everything about the butterfly. It's all broken down in 30-minute modules. Get the PowerPoint, and then I've got some great bonuses that go with this $97 course. Now, if you decide you don't want the course, but you come back, later on, it's $197 on my website. So it's there if you like, or you can get it today at $97 plus these bonuses plus a money-back guarantee. So if you're not happy with the course, just send us an email. We'll refund your $97. So it's really a win-win. If you've never done a butterfly, or if you're just starting out trading, this is a great way for you to get started. So use that link here, PowerCycleTrading.com / go. And then here's the bonuses that you'll get. We'll also do then a follow-up Q&A. This will be live. We'll do this in about 2 weeks, so you'll have time to go through the course. So that'll be live, and that'll be recorded, so you can come in and ask questions. Or if you can't make it, you can send in by email your questions ahead of time, and we'll answer your questions at the first part of the Q&A. And then you're going to also get bonus 2, which is my option strategy manifesto. This is 15 option strategy diagram of some really great strategies, options. It shows you the diagram of those options and the definition, or kind of a summary of what they do. So you'll get that. And then you'll get my Greek power tool guide. So these are both things that you can print out, put on your desk. If you like, I'm a paper guy, so still like to have paper on my desk with things. I don't have to go to the computer to look up everything. So this is a Greek guide, so it gives you the summary of the Greeks, theta, gamma, etc. Now, the other bonus I want to give you for anybody that's never been a member to my trading club, you'll get 1 free month to the PowerCycle Trading Club, and we have a virtual trading room. We do Q&A every week, a lot of great benefits, which I'll show you. So this course package today, $97, and it's a fantastic course. And if you're not taking advantage of the butterfly, check the course out. You might decide that this is the only way you want to trade. And if you're not happy, then you just send us an email and we'll give your money back. So it's just a win-win situation for anybody that's here today. So 0 risk, 100% satisfaction guaranteed if you're not happy. So the on-demand butterfly course is what I call my step-by-step blueprint course on trading the option butterfly spreads, again, for high reward, low risk. You can see from those examples. So it's a 4-hour plus course. It's broken in 30-minute modules. You get the 213-page training manual PowerPoint. My courses are very, very detailed. And then we'll also do that 1 follow-up Q&A, which will also be recorded. You get bonus 2 will be the 15 option strategy diagram. So you get the diagram of, cover call, back ratio spreads, and summary of the strategy. So you can keep that on your desktop and look through it and get familiar with these strategies. And then this is also, so you can print out, put on your desktop. This is a simple, brief option reference guide for the Greeks. So, what is gamma, what is theta? You can put that on your desktop. 1-month trial membership to my trading club. And then in the course, we go through the core basics that traders miss when using option butterflies. Which option Greeks are vital to this strategy? How, why, and when to use the long call or put butterfly, broken wing butterfly, ratio butterfly, directional butterfly, iron butterfly, that vacation butterfly. So go through all these structures in detail in this 4+ hour course. Optimal times to capitalize on the different butterfly strategies, how to structure these things for 10-to-1 return or higher on $10, capital, how to profit from option volatility collapse and theta decay using the strategy. And this is a big part of it too, then pinning. If you're not, familiar with option pinning and how to use it, this is a big part of the course. Option pinning, what it is, how to trade it using the butterfly, how to target that optimum expiration strike, pinning strike, the profit formula I use for that using the butterfly, and then price target setups for the butterfly using Fibonacci. I go through Fibonacci analysis for setting your targets like I showed you earlier, and a step-by-step checklist of what you need to know, execution management, and the big part, even if you don't want to use the butterfly for anything else, use it for hedging. How to use the butterfly to defend vertical debit credit spreads, how to use the butterfly to hedge your core position. So if nothing else, learn how to use the butterfly for your hedging of anything else that you're trading. So it's one of the best strategies out there I've found for my career of trading for hedging. Now in the trading room, we have in our virtual trading club, you'll get the trading room. We're open every day. And I'm in there from 9:20 a.m. till that's Eastern until, for an hour and a half. Then I come back in for the last hour, and we do future day trades, we do seasonality trades, we do earnings trades, we do butterfly, we do all kinds of different things. I do a nightly video update of everything that's going on in the market that I see, all the trade setups that we're looking at or doing, a live weekly Q&A every week. We did one yesterday, hour and a half every week, and those are all then posted to your members area, Traders Educational Vault. And then for every month you're a paying member, you get a $20 credit, discounts on all my courses and all my trading models. I've got 5 different trading models and things I've developed that you'll also get access to at half price as a member. So a lot of good stuff there. And here's a little feedback from 10. Here's thanks, Larry. This was one of the best presentations I've listened to this year. I'm also left with imagining the opportunities available for having fun and making money at the same time with this knowledge you've imparted to us. And then here's one from Sam. This was the best lesson I've heard on butterfly strategy. Thanks, Larry. And then greetings, Mr. Gaines. I want to take time to say thank you for your thorough explanation of your trading strategies and techniques. You make it easy and educational for someone to build their knowledge base. So hopefully you'll take advantage of this and check it out, PowerCycleTrading.com / and then just go. So that's everything there. Okay, so if you're using one contract, well, you'd need probably, I'd say $40 a contract. So question, is there a way to butterfly short calls only? Yeah, so you can use with the butterfly to structure the trade. If you're looking for a upside structure, you would want to use puts. If you're looking for a bearish or structure, you want to use calls. So in the course, I'll teach you both ways. So if you're have a directional bias to the downside, you structure the butterfly with using calls. If you've got a directional bias to the upside, you structure the trade using puts. And then for adjusting, there's so many different ways that you can make adjustments because you've got the butterfly. So if you have a butterfly, just think of it as 2 vertical spreads. So if you want to make an adjustment, one way to do it is just add an additional spread, vertical spread. So let's say you had a butterfly that, let me just pull up a chart here. So let's say you had a butterfly on, like here. Now, what is a butterfly? Okay, a butterfly is just going to be a vertical debit spread. Okay, so let's say you have a vertical debit spread and then you've got a vertical credit spread. Okay, so you've got the two together, that creates a butterfly. Now, if let's say you think the market's moving against you going up, you could add another debit spread to it to structure it to an upside move. Or if you think it's going down, you could add a credit spread to it for the downside move. Oh, wow, okay. Here's a really nice feedback. Thank you very much for that, Tom. David, I mean, sorry. Here's from somebody in the room here today. Appreciate that. Appreciate that a lot. Okay, if you're short a call, then all you do is you buy a call. Okay, so I'll just pull up an option chain here. So let's say, well, first off, here would be, I just happen to have Alibaba up here, but let's say somebody asked about, yeah, we have a live trading room. So yeah, here's the link again, PowerCycleTrading.com/go. Oops, that's the wrong one. Yeah, we have a live trading room open every day, and you know, if we have a setup, these are the type of setups and questions we'll go through. So if you have questions in the trading room, we'll go through those questions. And we do a lot of, you know, seasonal type trading, oil, etc. Just do a lot of different stuff. So let's say we had a butterfly here on okay. So let's say we had a butterfly. Let's say, okay, so Alibaba's trading here at 99, and let's say we think we're bullish on Alibaba and we think it's going to go up to, well, let's say we think it's just going to go out right here. So we could do a butterfly, you know, for expiration next week on the 9th, and let's say next week we think that Alibaba will go out here at, well, let's put it up a little bit higher. Let's say we think Alibaba next week will go out at $105. Okay, so we could do a balanced butterfly for $105 if we think next week it will go out there. Let's say based on, I'm just making assumptions. So let's say next week we think Alibaba is going to be at $105. It's got great, you know, open interest there. The Fibonacci levels, it looks very, you know, set up for 105. So you could do a dollar-wide spread or $2. You can do it as wide as you want, but the narrower you get, the less risk. So let's say you just did a 104, 105, balance, what we call butterfly. Okay, so if you see here, it's 104, 105, 106, dollar wide. Now look here, you've got a $4 debit. So that's the maximum risk. If you're wrong, you lose 4 cents, $4. Now, if you're right and it goes out at 105 next week, you'd make theoretically 96. Now, you're probably never going to make that, but that's theoretical. But what if you could make 30% of that, 40%, 50% of that? That's the beauty of it. So it's kind of like that lotto trade. Now, somebody asked about hedging it. So here is, oh, that was an earnings trade. Let me get, so here's the butterfly. So $5, right? Okay, so if you think it's going to go up and you don't like your position, or let's say you think it's trading down here at 99 and you think, oh man, I screwed that up. I shouldn't have done that. Well, you can shift that by selling another the bear call credit spread side of that. So if there's any premium, I don't know if there is, but we can look at that. So you could sell one, you could add one more layer to it. So you could sell the 105, 106 as a credit spread. You'd receive $16, not much, but this is what it will do for you. So now you've just converted that to what we call that ratio butterfly. Okay, so now you've gone from, you know, your original trade was not losing much, but, you know, $5 to adding this other additional layer on this particular, now you go to a potential for $11 credit. See the blue down here? So you shifted this to making $11 if it goes down. If it still comes back up to 105, you could still make 103. And if it goes up further, you increase your risk to the upside. But that's how you can restructure and adjust. Now, let's say somebody said if you're short a naked call, let's say you're short a call, let's say you're short the 103 call, something like this, and it's trading at 99. Well, let's say you're a little bit further out. Let's say you're short the 104 call naked. Okay, so you've got, you know, $72 you make, but you've got unlimited risk to the upside. But you're selling this call thinking it's just going to go down. Now, if you're wrong, all you have to do is, before it gets to your short strike, you know, you could buy a couple of different things you could do. You could buy like a 102 call against it, or you could sometimes convert this to what we call a back ratio spread. So here would be, we'll put this in on the analyze. So here's your short call right here. Okay, so you're short this call now. If it goes up, you start losing a lot of money. If it goes down, you make your $72. Now, if all of a sudden it starts spiking up, now one thing you could do is you could buy two 105 calls right here. So this is going to convert it to a back ratio spread. So that's kind of one defense. So here's what you have. Now on this particular, by doing this two calls just above it, you're converting this to what we call a back ratio spread. And you can see here, then if you're wrong, you were wrong. You know, you thought it was going to go down, but it starts flying to the upside. Look at that. See, then you start making big money. So that's one strategy, and that's given in that option diagram. So PowerCycleTrading.com/go. So that's if you're short something, you can flip it, hedge it, doing what we call the back ratio hedge. Hey, Charlie. Okay. Any other specific questions here? So Brandon, did that help you? That's just one idea. There's a lot of different things you could also do, but that's one thing you could look at doing. Whoops. Yeah, so PowerCycleTrading.com/go. Yeah, you're welcome, Brandon.